Good afternoon, everyone. Welcome to today's market stream. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the four major market indices, we'll also take a quick look at the U.S. dollar. We'll see how it's behaving versus a couple of different currency crosses. We'll look at gold, silver, and we'll also look at Bitcoin. And then once we finish with that, we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. I'd be more than happy to go ahead and take a look and analyze whatever chart you're looking at. It could be a chart that you own. Maybe it's a stock that you're trying to figure out whether you should buy or sell. Or maybe it's just a question on a pattern. Anything like that, I'd be more than happy to help out. If you like what you see here, you can always follow me on Twitter at the name StockDarts. YouTube, same thing, StockDarts. Or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including giving watch list ideas, trade ideas, or just kind of any kind of trading thoughts that I have based off of what we discuss on these Wednesday market reviews. You'll also find reposts of these market reviews on that Patreon page as well. Let's go ahead and get started. First thing I'm going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we are right near all-time highs yet again. The market has been in an interesting place over the last couple of weeks. I know we didn't meet last Wednesday, but not much has changed really since around the middle of March. And technically speaking, really nothing has changed since about February. We've just been kind of consolidating near all-time highs and just kind of chopping back and forth as the market tries to figure out what it wants to do next. I think that we're at a spot where we're really having a hard time really going upwards. As you can see, we come all the way back here to where we were at the beginning of February. We started to make our way up towards the 395 area on SPY, and then we had this really volatile wedge as we kind of went back and forth. Now, we did hold our trend, and that's a good sign, and we were able to kind of continue climbing upwards. Now, we're not seeing the same pattern of behavior across the four market indices, but on the S&P 500, as you can see, we did hold the upwards trend, and we actually made new highs. But as you can see, it's not much. We went from 394 or 395 to about 397. So about a 3-point difference as we continue to try to grind our way upwards. And so the theme here is that we're reaching a point where I think that this rally is getting a little bit long in the tooth, and we are starting to encounter some pretty good supply, some pretty good selling pressure. And that was pretty obvious when we had this broadening wedge where you could see a lot of big selling candles, and every time we tried to make our way up, it would immediately fade and we just come right back down. Now, the tables have turned a little bit over the last couple of weeks, where now it seems like every time we try to sell, we actually bounce, right? But in the end, really what we're still seeing is you could divide the market into these 2 or 3 day segments, where you have a bullish market that lasts 2 or 3 days, and then it looks like a bearish market that's topping out for 2 or 3 days, and vice versa, and it keeps going back and forth. But I guess the good thing you could point from this is that the bulls are still not relinquishing control of the price action, despite the fact that the bears and sellers are starting to put a little bit more pressure. Overall, the price trajectory has not changed, and we're still kind of climbing upwards. My thought process as far as what's going on here is the same that it's been for the last few weeks, which is a market that I feel is beginning to get a little heavy. I don't really like the price action too much, even though it looks good on the surface. If we look at just the indices, if you look underneath the surface and you look at a lot of different names, a lot of them are struggling, and we're getting a lot of rotation going on right now, and it's leading to pretty erratic behavior. And that tends to happen as the market starts to transition, which is what I think is happening right now. Is that we are transitioning towards a more neutral environment, where we're going to maybe chop back and forth as we start to make our way into the summer months, and through spring, and then possibly into the summer months. And we'll see a little bit more of that as we go ahead and take a look at the four indices together as a whole. But I would say one of the big characterizations of the stock market over the last few weeks has been this transition from strong stay-at-home names and strong tech names into what I would consider more recovery type names that struggled a lot in 2020 and have finally started to pick up steam in 2021. Airlines, restaurants to a certain extent, but not quite as much as the airlines. because restaurants did still stay open, and we're still able to offer carry out and stuff like that. But retail stores, a lot of energy related names, a lot of stuff that really kind of struggled throughout 2020, some industrial stuff, and it finally really rallied through February and March. And as that happened, we had a concurrent kind of a drop or pullback in the NASDAQ and in a lot of the big tech names, and particularly in a lot of the stay-at-home names. And those of you that are regulars here, this is no surprise to you. You know, we've discussed this pattern quite a bit recently. And what I'm starting to see now is the beginnings of maybe a rotation back. Now, it's as often happens during these transition times, there will be a point where some people get in early and some people get in late, and some people don't realize that the trend is shifting. And so we still have some tech names that are struggling, and we still have some recovery names that are still trying to rally, but we're starting to see a little bit of a shift in character. And you can see it a little bit if you look at just the four major indices. You'll notice that the tech is NASDAQ is leading the way today with nearly 2% gain, as opposed to maybe the Dow, which has been leading throughout the last month, which is actually a little bit red, and then IWM, which has recovered a bit. But as we see when we get to their chart, they actually pulled back quite a bit. So what we're seeing now is the markets are holding up, but we're seeing a little bit of rotation, and we're starting to see some other names start to pick up a little bit of steam, while some of the recovered names maybe slow down a bit. Now, will this pattern persist for more than a few days? I think it's a little bit early to tell for sure. There's typically what happens in these scenarios is you'll start to see some life creep into these tech names, but then they'll struggle, and you'll get some of the recovery names do better again, and then eventually you'll see the tech names kind of get their second wind and then really start to run. But what I'm starting to see here, and we'll get into that when we get to tech, when we get to the NASDAQ, is we're starting to see a little bit of signs of life from some of these bigger tech names and some of these work from home names that are finally starting to maybe bottom out. And I'll go through a few of them once we finish looking at the markets, just to kind of give you guys an idea of what I'm looking at. Now, as far as the SPY is concerned, if we're just looking at it in a vacuum and trying to figure out what it's doing, like I said, this is bullish, right? We've got a nice extension and a nice breakout from the last few days. You can see we had a big bounce off of the 50-day moving average and off the 20. Then we had a couple of days of consolidation, and now we're starting to get a range expansion into all-time highs, which again is positive. There's nothing negative here. Whether we can break through this and continue this channel and continue extending it upwards is really the key. If we struggle, it might be another one of these scenarios where we've had 3 or 4 days of bullish action, and now we're going to get 2 or 3 days of bearish action again to come back and retest these moving averages. So keep an eye on how we behave here around 397. I think from 397 to about 400 is going to be a major area for us to really kind of break through. And if we cannot, then we're going to come right back down and hit the 20 and the 50. So as far as overhead levels or overhead resistance is concerned, we're at it right now, and there's maybe a couple of points of leeway until we get to about 400. And I think once we get to 400, that's probably about the ceiling that we should expect, because that's a big fat round number that a lot of people are probably looking at, and it's probably going to give us more selling pressure, because like I said, over the last couple of months, we have seen a lot of selling pressure despite the fact that we keep chugging along. We've seen a lot of selling in separate days and a lot of volume coming in, showing that there is a little bit of we're starting to get a little bit of lack of resolve as we get towards these higher prices. And some bulls are maybe not willing to hold through that. So, that's going to be the key area as far as overhead levels are concerned. Now, below us, well, we've got the previous highs and the previous level of resistance right around 393 to 394 would be the first line of defense, but I don't consider that to be a major level that's going to really hold. I consider all of this price action really kind of the same. So I think that we probably have to come back down and test the 20 and the 50 and challenge the intermediate term trend if we do start to pull back. So those are the key levels that you want to watch. Is you want to watch the 20 right around 391, 392, but more importantly the 50-day moving average in the upper 380s, around 387, 388, depending on when we get to it. This channel, this trend line that I'm drawing, it's not that critical at the moment. It is starting to gain a little bit more significance, but really it's more of a kind of a guide telling us where the moving averages are. As you can see, the start of this trend line doesn't even touch any candles. I'm not using this as a technical trend line to give me any kind of decisions. This is more just to give you guys a broad picture of what the price action is doing. So I wouldn't use this trend line as a level of support at the moment, what I would consider is the moving averages, because I think at the moment that's really what's kind of defining the momentum and defining the sentiment in the intermediate to short term is what the moving averages are doing. And as you can see, we've been in a pretty strong uptrend since the beginning of the holiday season last year, and we're starting to reach a point where it's getting tired. You can see when the moving averages were spreading out, that's indicative of a trend that's beginning. And now that the moving averages are closing up, that's usually indicative of a trend that's starting to get tired or ending. Now, with respect to what I'm talking about right now as far as time frames are concerned with a trend, I'm talking about this rally right here. I'm not talking about longer term trends. We go ahead and take a look at our weekly chart. The long-term trend is still very much intact. The moving averages on the weekly chart are still very spread out and are still indicating that the market wants to continue higher, or, well, the momentum can persist much longer. So I'm not really concerned right now with the long-term trend, with the bull market, with a impending top in the overall markets. That's not at all what I'm concerned with. What I'm looking at right now is more short-term oriented. I'm looking at what we can do over the next couple of weeks or even over the next month or two. And in that particular perspective, it looks like we're starting to get tired. Like I said, you see the moving averages start to get closer together. Now, they haven't crossed, and they haven't really given us indication that the trend is done, but we're getting indication that the trend is starting to tire out. And so that's one of the things that we want to watch, is to make sure what happens as we come back and test these moving averages. The more often you test them, the more likely they are to be violated. And so the key is to make sure, as we get to those levels, to kind of keep an eye on price action and see what's going to happen next. Right underneath them, you can see a pretty decent level of horizontal support, right around 385, and that's going to kind of coincide with that. So any kind of real pullback, we're going to have to look at that as a key area that can give us good support, even if we start to transition towards a more sideways market, which I still think is probably going to be what's going to happen. So from here to next Wednesday, I don't expect any kind of support levels below that to be tested. But if for whatever reason something happens in the market and we do get a much stronger sell-off than I'm anticipating, the next level is right here, right around 375. But again, I don't expect that. I think if we're going to challenge this rally and this trend here, we're going to do so around the 385 to 384 area at the worst. And so that would be the level that I'd look at as far as support is concerned from here to next Wednesday, and possibly in even a couple of weeks from now as we head into the middle of April. So those are the key levels on SPY. Upstairs we got about 397 to 400, and then down here we've got the moving averages, which I believe are going to be the important barometers as far as whether the bulls are still in control of the price action. Now, as we move to the NASDAQ, we'll see there's a pretty different picture. In this particular case, we have an index that has already lost its upwards trend, and it has already transitioned towards a sideways range, which is what I'm anticipating all of the markets to do. This, of course, is exactly the symptom I was describing before, it was caused by this rotation out of tech and into some of the recovery names, some of the small cap names, some of the energy names, some of the travel names, stuff like that, right? So a lot of tech names suffered, and they reached the point where they were probably just overvalued, or people just needed to take profits somewhere in order to start investing in some of the more beat up names that were starting to offer better upside. And so that's what typically happens. It's no big deal. Like I said, it doesn't mean that it was the end of our bull market. It's just a matter of money rotating back and forth, trying to find out where it can get its best rewards, right? And so the NASDAQ struggled over the last couple of months, and as you can see, it's starting to stabilize, and it actually looks like it's starting to want to bounce again. Now, there is overhead resistance that we're going to have to pay attention to, but we have a nice little, I'll draw a little trend line here to show in the very short term. We'll change that one to green, just to give you guys an idea that this is bullish, right? So we had our first pullback, right? After we topped out around 335, 337, and eventually we were able to break above that, but the momentum wasn't able to sustain itself, and we ended up just kind of continuing to trade sideways. Had a nice little inverse head and shoulders that was printing, but we weren't really able to break past above it. Now, the next level of consolidation, this little channel that formed in between the two descending trend lines, We finally just broke out above that today, right? So this is showing that there is more momentum starting to come into the tech names, and that they're finally starting to pick up a little bit of steam, and they want to probably come back up and retest 324. Now, we're not out of the woods. This could still just be another bounce inside more of a broad horizontal channel. We could draw something sort of like this. And then the top of the channel, it could coincide with somewhere around 329. It could coincide with all-time highs, or it could coincide with what we're dealing with right now, which is this level right around 323. At the moment, that's not really the key idea here. The big thing is to see what happens as we get back above these moving averages. Now, as we discussed the moving averages on the S&P 500, as you can see on the NASDAQ, they've already crossed. Now again, because they cross like this, that doesn't mean that it's the end of of a long-term bull market, or we're topping out. It just means that this particular rally is done, and that the market needs to trade sideways and needs to find an equilibrium in price. This is kind of normal. I know it's easy to panic when you see something like this and to say you want to get out, but the truth of the matter is that this is just normal price behavior. What's going to happen, it's always going to happen in any equity that you see, is eventually people are going to find this to be too high value, right? They're going to think it costs too much, and they're going to wait for prices they consider to be value. And so at the moment, the NASDAQ is still searching to figure out where people are willing to buy with conviction. We found some buyers here around the 310 area. We found a nice little batch of buyers here at 300. And now the question is, these new buyers that just stepped in, do they consider 324 to still be a good price, or are they going to consider that to be overpriced? And if they don't, then they'll push the market back up into the 330s. And at that point, then we'll see just really how much conviction there is in this. Now, like I said, I expect this to be sideways. So even if we do push back above 325, I don't expect a strong rally to new all-time highs. I expect this to continue to kind of build out this horizontal channel that's beginning to form, and we'll eventually figure out where the exact ceiling of that is going to be. But what we are seeing here, like I said, is money starting to rotate back into tech. And like I said, we'll highlight a few different tech names, and we'll see what they're doing. And as you can see, they're going to be doing something very similar. We'll look first at the FANG stocks. You can see Facebook has actually picked up a lot of steam since we last looked at it a couple of weeks ago. Found good support at the 200-day moving average, and is starting to rally right back up towards near highs. Amazon is still kind of struggling, but you can see a nice candle today. It's up about 2%. Still kind of trying to get above its 200-day moving average. You can see all the moving averages sideways, but it did find good support at the bottom of its range again. And Amazon, I think, is a good indicator here of exactly what's going on, and a good predictor, I think, of what the markets are going to do. It's been kind of ahead of the curve throughout the last year, and as you can see, it transitioned to going sideways a long time ago. It actually did so in the middle of last year, and it's been trading sideways. Now, this is, generally speaking, this is what I expect or anticipate out of the overall markets. If we want to compare, I would say that the NASDAQ is right around maybe here, and the S&P 500 is still maybe here. And as you can see, the NASDAQ has already done a lot of sideways consolidation, and has built up a base for quite a while. So this is probably a good tell for us as far as when we're going to eventually emerge outside of our broad range consolidation, and what the next leg in the market is going to be, whether it's going to be another rally or whether it's going to be a further drop. Amazon might be a good tell on that, so something to keep in mind. Because like I said, it seems to be quite a bit ahead of what the overall markets are doing, and they're kind of following in Amazon's footsteps. The next key, of course, is to get back above the 200 and the 50 and to start challenging the top of this range. It's not quite as strong as Facebook at the moment, but it's doing okay. Apple, we can see the beginnings of an attempted move again. Very similar to the Qs. We had that descending trend line that we're able to break above, but we weren't able to really push past it. But same general idea, where we have a new trend line that we're starting to break above today, right? So, the initial breakout kind of faded, and there wasn't enough momentum to push it through the moving averages. But now we're getting another attempt at it, and this is kind of the pattern that I'm seeing persisting through a good amount of tech names. Not necessarily all of them, but a good amount of them. Netflix, more like Amazon, it's still kind of chugging along, but as you can see, there's still a trend line here that we have not broken. And so that's going to be the next key. But as you can see, found support at the 200 and is trying to kind of bounce. Google's still kind of maybe the most bullish of them, and it actually, same as the others, it found good momentum today off of this minor pullback that we've been seeing. And finally, Tesla's doing something very similar to Apple, where we had that descending trend line, we were able to break, but we faded quite a bit. And today we're starting to make our way back above the 20 and back above some of this bearish sentiment. So if you look at the big tech names, they are all doing something very similar to the NASDAQ. And I think more than anything, it's pretty clear. They're still struggling. A lot of them are still kind of hovering close to the 200-day moving average, but we're starting to see some buying momentum kind of seep back in, which is critical because they've been kind of struggling. But these are the names that are kind of the anchors in our market right now. There's a reason that we follow the FANG stocks closely, is because they kind of dictate where the market's going to go next. And while it's okay for them to take a breather like they've done over the last few months, eventually we want to see momentum come back into them. Now the question will be, is this going to be short-lived and it's just going to be a 2 or 3 day rally, or will it be the beginning of a bigger rotation back into tech and away into the others? I think for the moment, this is probably still just a shorter-term impulse, but I think it is the beginning of a more intermediate-term return of capital to these guys. And so what I mean by that is I expect the initial bounce that we're seeing today and then over the next couple of days to probably struggle and then fail, but not completely fail where we head back to lows. It'll probably lead to a consolidation and then eventually to a bigger rotation back in and a move closer to the ceiling. So I would pay attention to this and maybe participate in it, but don't get too caught up in it, because there's a decent chance that there's still going to be more consolidation and more rotation, as some of the other names in the Dow and in IWM or the Russell 2000 need more time to tire out. All right, so back to the NASDAQ. And like I said, I'll point out a couple other tech names and a couple other work from home names after we cover all of these, after we cover the markets, in case no one has any chart requests. By the way, those of you that are in here, thank you for attending. I hope that you are getting good value out of this. If you have any questions, feel free to type it in. If you want me to look at a chart or you want me to expand on whatever I'm pointing out, feel free to type it in. I'd love to get some interaction, be able to see what you guys want. This is for you, it's not for me. So let me know what it is that you want me to spend more time looking at, and I can go ahead and give you that. All right, so the key levels on the NASDAQ that are kind of critical. Obviously, we just kind of saw 324 is pretty important. As you can see, that's been a pretty big ceiling in the price action. It's right where we broke down from this channel, and that's going to be an important level to really break above. However, if we do break above it, there's still more resistance right above there around 328, 329, and even more obviously at all-time highs. So if we falter here and we head back down, the key level, of course, on this side is the 310, and then below that 300. We've already identified these, and I don't expect us to really lose that and come down and test the 200 anytime soon. Like I said, I feel like we're beginning to see a little bit more bullishness come back into the tech names, even if the overall markets are maybe kind of giving us weird pictures or weird vibes. So far what we're seeing here, the SPY looks pretty good at all-time highs. The NASDAQ maybe doesn't look great when we look at it like this, but in the short term looks like it's getting a little bit of momentum. Let's see what's happening with the Dow. So with the Dow, as you can see, almost the same picture as the S&P 500. We're consolidating near all-time highs. Moving averages still intact, still spreading out, showing that the Dow is starting to gain some steam again. And I feel like the Dow Jones has actually been the leader in the overall markets over the last, I'd say over the last 3 weeks or so, maybe month. Before that, it was IWM leading the way, even if the Dow was kind of doing well. The Dow did threaten to break down in late February, early March, but that led to a pretty impressive rally and a big move. and an acceleration of the trend. As you can see, the trend was pretty steady, and then we had this big acceleration through the top of it, which was short-lived, and it's hard to sustain those kinds of explosive moves. But the key thing here is that we came back and tested the 20, the buyer stepped right back in and pushed it back up. Now, I still feel like there's a lot of overhead resistance. I'm not that excited about a strong breakout from here. It could happen. I could be wrong. The bulls could try to push the market even further upwards. And if that's the case, we'll see a big breakout here. And we'll probably see the same thing on the S&P 500. If we continue the rotation game and tech continues to gain strength, then we're probably going to need the Dow to kind of break down a little bit and head back and test the 20. But like I said, I think one of the key points to point out here is that the Dow is actually picking up some momentum because people are expecting a rotation back into or a recovery into a lot of the names that struggled. We did this a couple of weeks ago, but we're going to do it again today. I want to go ahead and point out the Dow components. So we go to the index and we look at the Dow Jones. As you can see, obviously it's only 20 names, or actually, well, 30 names. And if we look at their charts, again, you can see stuff like Apple, which was a tech name, is maybe doing not that great. But if you look at stuff like Boeing, Caterpillar, Cisco, Chevron, Disney, you can see that Goldman Sachs, you can see that Home Depot is a big one. You can see that we're starting to see a lot of improvement in some of these areas that maybe took a bit of time to kind of get their momentum back after 2020. And they've been starting to get some nice rallies. You can see Dow Chemical, another one, has been rallying pretty steadily since the end of last year, which is when we started to get really more information about a vaccine coming. American Express, of course, a good gauge for consumption, and it's starting to kind of go up. And so a lot of the Dow components are actually beginning to pick up some steam and are beginning to show nice growth. As we start to get, at Triple M, another one that you can see really picking up over the last month or so, giving us an idea that the market is expecting money to start to be spent again, and for people to kind of leave their homes and start working more, traveling, just generally consuming and using up energy, right? And so a lot of these areas that struggled throughout 2020, they're starting to do a little bit better. How long will this persist? Will we see rotation back into tech in the near future? I think, like I said, that it's going to be a while before we transition back fully into tech, because these names still have more room to recover, and these kinds of moves, they have momentum to them, right? That's what the moving averages show us. That's what these channels show us, and it doesn't die down right away. So I expect this to kind of persist. Eventually, we will transition into stronger tech names again, and these names will take a breather. But we're at a point right now where we're starting to see a little bit of fluctuation back between the two, but it's not a dead move yet, right? And so for those of you that are on my Patreon, that are regulars and your subscribers, you'll know one of the trades, and basically the focus of this week, we were looking at ERJ, or Embraer, right? And these guys, it's very similar to Boeing. They make airplanes. As you can see, they were kind of pulling back, and they had a really big move for us yesterday. And today an inside day, but this is the kind of recovery name that is still doing well, and I consider it to probably continue to keep kind of climbing. And I don't think that we're done with these. So I wouldn't ignore these recovery names. You look at Boeing doing something very similar. A lot of airlines are doing the same sort of move. And so the market still is flowing into these, and it's not going to just disappear with 1 week of rotation. So continue to look at the Dow and look at it as the leader right now. If it can break out to new highs, I would expect the other markets to follow, or the other indices to follow through. If it pulls back and starts testing its moving averages, I'd expect the other markets to probably do something similar, with maybe the NASDAQ being the one that's a little bit different, because that's the one that's been beaten down most recently. Now, key levels, like I said, we're right overhead is major resistance. If we could push past that, that's a pretty bullish indicator, and it means that we should probably get a little bit more bullish ourselves. If we falter here, I think that we have a pretty decent level of support right here, right around 324 to 325. We'll probably take a breather on the 20-day moving average. Uh, and then more critical support down here at 320. I don't expect this to be challenged from here next Wednesday, even the Wednesday beyond that. When we do test it, the 50-day will probably coincide with that, or actually probably be beyond it, but we'll see. But overall, this is still very bullish, and I don't expect this to change anytime soon. I still think that this is probably the leading index right now, and is going to be the one that we can maybe use as a barometer of the overall markets. Now, the last index to look at is IWM. And as you can see, IWM has started to lose a little bit of its luster. It was the leading index throughout the beginning of this year, and then we started to see a transition from some of these small caps into the Dow components, particularly as we headed into March. You can see the broadening wedge. It put a little bit of an impact on IWM, and then it did rally just like the Dow into mid-March, but then as you can see, we got another broadening wedge here. Now, depending on how you identify, how you go ahead and draw it, it could be that we're actually breaking out today, or it could be that we're still in the process of it. I would say we're in the process, but it's looking like we're actually trying to bounce here, as you can see. And the big key, more than this breaking out of this wedge, is getting back above the 20 and the 50. So, we discussed already the dynamic of the moving averages and how they work. I know a lot of traders, they like to use moving averages as triggers for trades, whether you cross one way or the other a moving average. That's sometimes a good use or utility case for them, but I find that the biggest thing that they give us is a broader picture of what sentiment is. And I find that what's important is sometimes to keep an eye on the distance between them and their direction, obviously. Now, it's a lagging indicator, of course, and the fact that they've turned sideways should be evident just by looking at what's happened over the last couple of weeks. But the key thing to point out here is, as the trend started, you can see the moving averages got pretty wide. And now that they're starting to get closer together, again, it's showing us that momentum is fading on this. And it's following in the steps of the NASDAQ, which already kind of did this, and then eventually crossed and started this coil where we have a sideways price environment. And that looks like might be what's happening with IWM. As you can see, the moving averages are basically flat now and trading sideways. We've already identified a pretty good support area down here around 205, or really about 208 to maybe 210. And then the ceiling, of course, is going to be up around 230 to 232. The key in the short term is, can we get back above the 20 and the 50? If we do, then we're likely to come up and test 225, 227, 228. If we roll over again, we're going to come back down and test 208. And so one of the things that you'll notice here now, as we looked at the four major indices, is that they're not all moving together. Typically, if they're not all moving together, we don't really have a strong trend in place anymore. If we looked a couple of weeks ago, or maybe a couple of months ago in February, all of them were in the same channel. All of them were climbing steadily together. We've reached a point now where the NASDAQ and IWM have transitioned towards a more sideways environment. The S&P 500 and the Dow Jones are still looking like they want to break out and continue upwards. But when you have the four of them going in opposite directions, that usually leads to choppy price action. And that's what we're seeing right now. And that's what we've seen for the last couple of weeks, is you'll see the beginning of a move, and then it can't sustain itself, and then you get what looks like a strong move in the opposite direction, which is followed by a strong move in the opposite direction, which is followed by a strong move in the opposite direction. That's not conducive to good trades. And so, for those that follow me on Patreon, you'll know we've been trading pretty lightly, and we've been trading pretty cautiously for the last month, because the market keeps going back and forth like this. And so I find that it's easier to look at range-bound trades and to look at support plays and to look at quick bounce moves rather than trying to get an extended momentum play where you're trying to catch the meat of a big move. I just want to catch these fluctuations back and forth as the market tries to stabilize. and figure out what its next move is. And so my guess is that we're going to do what Amazon already did and what the NASDAQ is starting to do and what IWM is going to start doing, which is start to trade sideways and build up a range and start to do something maybe similar to what we saw last summer, where we had a nice bounce and then we kind of had to trade sideways for a few months. And this could be the beginnings of something that takes a couple of months or 3 or 4 months to trade, or it could be something that maybe is the beginning of a multi-year sideways move. Again, if we go to the weekly chart, you can see that the IWM and most of the indices were trading sideways for a good couple of years before the big shakeout that happened last year with COVID that led to the big drop and the big move up. I think SPY gives us a much clearer picture. And again, you can see we had a pretty sideways range for a few years before we finally started to break out, then got interrupted with COVID, but eventually recovered and sort of did the same thing. We've rallied a long way from the bottom here, the COVID bottom around 230, all the way up to about 400. That's a long move. And at some point, we're going to have to transition towards a sideways market. And I believe that's what we're seeing now. Now, it could just be a stair step. It might not necessarily be a 2 or 3 year consolidation like what we've seen in the past. But I feel like this rally is starting to get tired, and that's what we're starting to see. Even if it's not reflected on the SPY right now, and it's not reflected on the Dow, it is reflected on the NASDAQ, and it is reflected on IWM. So, if you're a trader, if you're someone that needs to trade for income, you need to continue to trade, obviously, but you have to understand what kind of environment we're in. If you're someone that just trades as a hobby, it might be better to wait for clearer price action than what we're seeing now, and maybe, or just kind of take it lightly and not get too aggressive right now, because we're not in a market that's conducive to really good swing trades. We're in a market that's, you almost want to like scalp on a swing level. So keep that in mind. So that's my analysis of the 4 major market indices. If any of you guys have questions, feel free to type it in. I'll be more than happy to kind of give you more analysis or more thoughts on what I'm thinking. Let's take a quick look at the US dollar. A lot of what we're seeing is actually based off of the US dollar, believe it or not. It feels like over the last year, basically the last year, and maybe the 6 months in particular, that we've started to get into a bit of an asset bubble that has been beyond just the stock market. And seeing a lot of really strong prices in crypto assets, in collectibles, even real estate has been picking up a lot of steam. And a lot of that has been because of a dollar that really is offering no kind of value, no kind of return. And so people have been trying to figure out where to put their money in order to get return. The fact that the dollar is finally finally bottomed out and is starting to regain some momentum is part of why we're starting to see some of these areas stall out a bit. And why the market is starting to stall out a bit. So, obviously most things are priced in terms of US dollars, and so if the US dollar gains value, then they're going to kind of struggle to hold their value. And conversely, when the dollar loses a lot of value, then the other things are going to feel higher priced just by virtue of the dollar being worth less, right? So, it's important to follow what the dollar's doing, even if you're not a forex trader, even if you're not someone that likes to trade currencies. It's important to understand what's going on in the currency market, because in the end, this is still what's driving price action in most other areas. The dollar's finally picking up some steam. I still don't think it's ready to really rally. I think we're anticipating maybe rate hikes in the near future, or it could just be the fact that it reached the point where it was just too low value. But it did bottom out around 2420 on the UUP index. It did break above this 2480 or so area, and it's trying to make its way back up to either 2520 or 2550. And we'll see what happens as it gets to those areas. If we look at the individual currency crosses, we'll look at the US-Euro cross, which is basically an inverse of that. And you can see the Euro has hit some important support. There's maybe potential for a little bit further drop down to about 116, 115. It needs to find stability here. The dollar has had a pretty big run against it, and looks like it wants to push a little bit further. But I imagine that at a point here, the euro will kind of bounce back, even if it's just a temporary snapback. But the dollar has made some headway here. You can see it's broken through the 200-day moving averages. The 20 and the 50 are moving down. So it looks like the dollar is back in control and the euro is kind of struggling a bit, which again shows that the U.S. dollar is picking up a little bit of strength. The U.S. dollar Japanese yen cross has been obviously very strong for the U.S. dollar. I think this one has been a really good indication of what we're starting to see, but also an indication of Japanese yen weakness. And this has been a massive rally and a massive move up. And I hope some of you guys, I know not a lot of people trade this, but I hope somebody was able to benefit from this because this is a pretty critical breakout. And then the last chart we want to look at is the U.S. Canadian. Now this one, this is a totally different picture. And then this again is going to be a function of oil. Oil being a big trade between the U.S. and the Canadian economies. And so the U.S. dollar has kind of struggled because the Canadian dollar has picked up strength because as we transition into commodities, oil has actually done very well recently. Now, over the last couple of weeks, oil actually has struggled a bit. You can see we had a pretty big drop back on March 18th. And we found buyers and we found some support here, but it's still kind of struggling. Now, very often when you have a strong trend like this, when you eventually break the 20, you test the 50, you usually bounce back and forth between the two moving averages. Usually that resolves in a move back in the previous direction, which would mean that oil would try to make another move back up, but oil needs to get back above 63 in order to maintain this. I'm personally not that big of a fan of it making back a move back above that because again, I don't really want higher oil prices. I think that we've gotten enough of an indication that the economy is recovering with the big move we've seen from 44 to 66. I don't necessarily want to see oil get back above 60s and into the 70s and 80s. So, I don't really care if it actually fails here, but the key here is, will it get back above 63, 73? If it doesn't, then it's going to come right back down and test this 58 area. And if it can't even break the 20, then we're probably going to lose the 50, and we're probably going to head back down and test the mid-50s, around 56 to 55, 54. So those are the prices to watch on oil and see what it wants to do next. It's in a transition, but I think it's still, there's going to be some bullish momentum that's going to persist a little bit longer. So I still anticipate this probably moving to the upside in the next few days, and that could lead to a bounce trade in some oil or gas names that maybe mimic this. All right, last thing we want to look at is gold and silver. For those of you that are regulars, you'll know I have not been a fan of gold or silver for a long time, and I continue to not be a fan of gold and silver. As you can see, the chart is pretty ugly, and the chart continues to drop and continues to behave poorly. I think this is a good example of why we pay attention to price action and why sometimes you want to avoid a trade even if it looks like it's at good support. We've kind of discussed this for a while now. Obviously, we look at it every Wednesday. And it was showing signs of poor behavior, since way back here in September and October and November. And as you can see, it's continued to kind of cave in and drop. Now, we had a nice move today. It's up almost 2%, which is interesting considering the dollar's actually shown recent strength. But I'm still not a fan. I'm not a fan of this. I'm not a fan of silver. I think for those that are playing the inverse dollar play or looking for a store value, we're still better off with Bitcoin. Well, hopefully you guys still hear me. Looks like my internet's getting a little sluggish right now. Comcast has been giving me some problems over the last few weeks, so hopefully it doesn't cut out here. All right, so as you can see with silver, with SLV, it looks a little bit better than gold, but it's still kind of struggling. Still below its 200. It's really just sluggish, and honestly, it's not something that I'm concerned with. It's not something I want to trade. I think, like I said, if someone wants to trade the inverse dollar play, if they want to look at a store value that benefits from the dollar losing value, I still think Bitcoin is the better play. Alright, so we're getting some internet issues. Hopefully you guys still hear me. If you don't hear me, just type it into the chat and let me know. Hopefully things picked up, but I got a network error on one of my computers here looking at it. All right, so I like Bitcoin. Now, the problem with Bitcoin, of course, is that it's